Hi, I'm Michael Green, Portfolio Manager with Teal Macro. I'm really excited to be here today to interview Rich Excell of Wolverine Asset Management. Rich and I have gotten to know each other over the years, in particular by arguing, as we'll talk about in our session. Rich brings a really interesting confluence of quantitative insights and discretionary management to macro, and it's one of the directions I really see the industry moving. It's moving away from this idea of machines or humans that are operating with impunity and using kind of, reading 10Ks, et cetera, and focusing much more on combining the two.
America's vastly over-retailed, over-stored. I think 5 times the square footage per capita devoted to retail in the U.S. versus any other developed country. Anyone just has to drive through any big city or even the suburbs to think, well, we've just got too many stores. And that's not, when we look at this, we don't start to think that when we want to necessarily fade the groupthink that we want to own all of these names. There's clearly going to be losers. There's going to be a lot of store closures. There's going to be a lot of names that might go away. So of course you want to try to avoid those to the best you can. But I think the way we try to think about it is there's still going to be value in a number of names. There has to be. We talked about before, there's companies that are still in business now that if you would ask anybody, you're like, I haven't shopped there in 10 years, how are they still in business? So there is some value to a lot of these brands, et cetera, or they're going to, even a poorly run store is going to have some areas, some places where they're being successful. So that's where we like to think about it, and I know you talked about it, who's the marginal buyer? And that's where I get interested when, could these names potentially be more attractive to a private equity buyer, a buyer outside the people like us to think about it, that are only looking at, well, next quarter's earnings, and are forced to think that way, or what are the flows into the sector. So that, but you're getting to the point really where you can put together some very large brands, and Amazon's market cap now is bigger than the next 10 retailers' brands put together, or next 10 retailers' market caps put together, which some might say that makes complete sense. But when you look at actually the cash flows that are generated by those next 10 versus Amazon, the cash flows actually dominate what Amazon's generating. Now, they're going to have to, the direction of those cash flows might be down because they're going to have to make investments. So you say, okay, well, again, there might be something interesting there, but are they doing the right things? And then you can look into some of the ComScore data and say, clearly Amazon is everyone's number one choice. However, quietly there's a few brands that are starting to creep up the rankings in mobile, in online with millennials. A Nordstrom's or eBay or Macy's, where they're starting to resonate a little bit at the margin. And so that to me is when you look at it and say there are potential catalysts for a few of these names to actually come out on the other side, and in a space that is going to potentially be look quite different, and there's a lot of disruption, but that disruption doesn't mean everyone goes to zero. And so it's our job to kind of sort through the wheat for the chaff.